Hey, when I'm looking for a reversal setup, there's a specific pattern I always wait for before entering a trade. In this video, I'm going to walk you through the key signals that suggest a strong chance of a market reversal, so you can stop chasing price and start trading with more confidence. Alright, let's dive in. First, we're talking about something called the fair value gap, or FVG. If you're not familiar with this yet, no worries, I've got other videos that explain it in detail, including a full tutorial. But now I'll give a summary of it. A fair value gap is a three-candle pattern where the market leaves behind a price imbalance, a sort of gap. It happens like this: candle 1 forms, then candle 2, and then candle 3. If the low of candle 3 doesn't reach the high of candle 1, it creates a space in between. That's your fair value gap. So, why does this matter for reversals? One of the first signs I look for is something I call an inverse fair value gap. Let's say we're in a bullish trend. Normally, bullish FVGs act as support, price bounces off them and keeps moving higher. But if the market is about to reverse, those bullish FVGs often fail. How do we know? Instead of price bouncing off the gap, you'll see a candle actually close through it. That's a sign of weakness. When price doesn't respect the gap and closes below it, it tells us the market might be turning bearish. At that point, we often see price start targeting sell-side liquidity, signaling a shift from bullish to bearish. The next important sign of a reversal is something called a change in the state of delivery. Now, I'm just giving you a quick summary here. If you want a deeper dive, there's a full video on this topic available on the channel, so feel free to check that out. So, what does a change in the state of delivery actually mean? Basically, it's when the market shifts direction in a clear and structured way, and it often shows up through the creation of an order block. Let's take a bearish scenario for example. Price starts trending downward, forming a pattern of lower lows and lower highs. Then something interesting happens. We get a liquidity sweep, also known as turtle soup. That just means price dips below a previous low to trigger stop losses, and then quickly reverses. It's basically a trap. After that, we usually see 3 strong bearish candles that push through the previous low. This is when an order block starts to form. Now here's the key part. The order block is confirmed when price closes above the opening price of the first bearish candle in that 3-candle sequence. That opening price is super important. It's the level we're watching. Once price closes above it, we've confirmed 2 things. 1. A change in the state of delivery, and 2. The creation of a bullish order block. From here, we can expect price to come back and retest the order block, since it's an area where large institutional orders were likely placed. And often, price will bounce off that zone and continue in the direction of the new trend. If you look closely at the chart, you might also notice something else. There was a bearish fair value gap earlier that price ended up closing through, flipping it into a bullish IFVG. That gives us even more confirmation that the reversal is legit. One last thing, it doesn't have to be just one candle that closes above the opening price. It could be 2 or even 3, as long as they break above those bearish candles. That still counts as a valid change in the state of delivery. One of the strongest signs that a reversal is happening is when the market closes above the swing high that led to the most recent swing low. When price runs up and fully closes above that high with a solid candle body, that's a clear sign of a market structure shift. It tells us momentum is changing direction, and that's usually the start of a potential trend reversal. This is where things get exciting. It's the perfect moment to start scouting for trade opportunities. Now, here's something cool to watch for. After the low that formed the lower high, you'll often notice a cluster of bullish candles, those that close higher than they open. This usually forms what's known as a breaker block. You can mark that area on your chart as it often becomes a key zone for price action. And here's where it gets even better. If there's a fair value gap within that breaker block, you've just found something special. It's called a unicorn entry model, a high probability setup where the breaker block and FVG line up beautifully. When that happens, it can be a great spot to enter a trade in the direction of the new trend. Let's break down the full reversal sequence you want to see. 1. Inverse fair value gap. A bullish FVG gets broken through, hinting at a sentiment shift. 2. Change in state of delivery or CSD. The structure starts changing, and an order block forms. 3. Market structure shift or MSS. Price closes above the swing high that caused the last swing low. 4. Breaker block formation. After that low, bullish candles create a key support zone. 5. Unicorn entry model. When a fair value gap sits inside that breaker block. Once all 5 pieces are in place, you've got a strong foundation to plan your entry. Now, where should you be looking for this reversal setup? In a ranging market, focus on the highs and lows of the range. When price sweeps a high or low, that's your cue to drop to a lower time frame and look for the reversal sequence. In a trending market, zoom in on premium discount zones, PD arrays. For example, in a bullish trend, bullish FVGs often act as support. Price may respect those levels and continue higher, so look for the reversal sequence there, targeting external liquidity like old highs. At opposing candle zones, these are spots where price moved aggressively in one direction, often leaving behind a demand or supply zone. These areas are prime for watching reversal setups. And finally, keep an eye out for opposing liquidity draws, like internal FVGs within a price leg, old swing highs or lows, external liquidity targets. Now let's dive into a real chart example so you can see how everything we've talked about comes together in an actual market scenario. We're looking at gold on the 1-hour time frame, and there's a lot we can learn from this chart. First, notice how the market is clearly in a bullish trend, price is expanding upward. This is important. In a bullish trend, we want to see bullish fair value gaps hold, meaning price should respect them and continue higher from that zone. So in this case, if the trend is going to continue upward, we want to see price come back, tap into that fair value gap, or order block, and then push away from it, maintaining the bullish structure. This setup gives us an opportunity to apply everything we just covered, the fair value gap, the supporting order block and the continuation in a bullish trend. By recognizing these components on the chart, we're able to build a high probability trading model that lines up with market structure and price delivery. So what happens next? The market pulls back into the bullish order block, finds support, and then trades away from it, just like we expect in a healthy bullish trend. After that bounce, the market forms new bullish structure, higher highs and higher lows. And once again, we see a new bullish fair value gap being formed. What does price do next? It retraces into that new fair value gap, finds support, and pushes away from it again, confirming that buyers are still in control. But what is noteworthy is that the price is making deeper corrections. That tells me momentum is slowing down, and the market may be shifting. So, price leaves behind an FVG, which now acts as a new demand zone. What's important to notice here is that every time price respected a bullish PD array, like a fair value gap or an order block, it created a new bullish fair value gap as it moved higher. Now, let's look at what happens next. At this point in the chart, price fails to keep the previous low, which is a sign of weakness and reversal. So what does that mean? This is where we can start looking for confirmation of a reversal using the full sequence we've discussed: inverse fair value gap, change in state of delivery, market structure shift, breaker block and potential unicorn entry. Now let's break down what's happening next on the chart. We have this swing high, and price trades into it with one up-close candle. As soon as we close back below that candle, that becomes our change in the state of delivery. But before this change happened, what did we see? We had a bullish fair value gap, and instead of holding as support, price closed through it. That tells us the gap was disrespected, and it now becomes an inverse fair value gap, a strong early sign of a potential reversal. With that inverse FVG confirmed, and the change in delivery now in place, the next thing we look for is the market structure shift. What do we need for that? We want to see the swing low that created the swing high get broken, with a full candle body close below it. That would confirm the market structure shift and give us added confidence in the reversal. At the same time, we can also identify a breaker block formed between the higher low, and the higher high. The bearish candles in this area form the breaker. Inside that breaker zone, we also have a fair value gap, which can act as both a target or a precise entry point. In this case, price taps into the fair value gap that gives you a valid entry point. You could enter at the retest of the fair value gap. Your stop loss would go just above the swing high. For targets, you can aim for the relative equal lows for your first target, then the next swing lows, and finally, the failure swing we identified earlier as a long-term target. This is just one clean way to approach it, by combining inverse FVG, delivery shift, and structure confirmation with smart entry and risk management. Now, the reason I've shared this full reversal sequence with you is to help you develop a focused strategy. You don't need to trade every single element, just pick one to master. You can choose to focus on the inverse fair value gap, the change in the state of delivery, a breaker block, or the market structure shift. All of these are valid price delivery arrays that can signal a potential reversal, especially when forming around old higher lows, or internal range liquidity zones. Personally, I prefer to focus on IFVG and changes in state of delivery. They've been the most reliable for my strategy. You should always combine two or more confluences before taking a trade. This highlights a key lesson: confluence matters. Assuming a fractal nature, let's shift our focus to the 5-minute timeframe. On EUR, price has been in a clear downtrend, reaching the previous day's low and forming a strong bearish FVG. However, after sweeping the liquidity below the low, price reversed and invalidated the bearish FVG, an early sign of a potential reversal. Upon closer analysis, price broke a previous higher low and established a new higher high, confirming the formation of a bullish market structure shift. Furthermore, since price moved above our bearish order block, we also have a change of character in play. Additionally, as the bearish FVG failed to hold as resistance, it has now flipped into an IFVG. At this point, we have multiple confluences signaling a possible reversal. In the latest bullish move, price also created both an FVG and a breakaway gap, accompanied by a breaker block. Therefore, we anticipate that on a retracement into the confluence zone, price will likely resume its bullish continuation. You can see how straightforward it is to connect these bullish and bearish signals to identify high probability zones where price is likely to react. The key is to build a clear narrative behind every setup. We can't just jump into a buy or sell without understanding the reasoning. We need to know what factors are aligning, what confluences are stacking up, and why the market is likely to move in that direction. So I hope this video was helpful. If you did find it helpful, please consider liking and subscribing, and if you have any new ideas for videos, please drop them in the comments below, and I do read all those. So thanks again for watching. I'll see you guys next time.